So what we're going to do is we have this interview to get to with Anna in a few minutes. We have a few stories we're going to cover. First, we're going to do the gem. Are we ready for the gem? With Crisco.
So the past few days, or I guess now a little bit over a couple of weeks, there was this massive yield curve inversion, which we've talked about before, basically has been a signal that precedes most recessions basically for the past 50, 60 years. Now, of course, this is just a measure. It does not create a recession. So there's been a lot of debate about whether or not there's going to be a recession in the future in, the media like Bloomberg and the Financial Times. Now, of course, most working people know that this economy is very rotten for working people, but it's been very interesting to see the reporting and what people have been focusing on, sort of showing signs that this economy might be in trouble. And of course, immediately everyone's been saying, well, this is nothing to worry about. But there are certainly worrying things. Of course, Trump's trade nonsense with China still is starting to it really has not manifested yet. And when that starts to hit, we're going to see a lot more tightening up of economic activity and investment. Bloomberg estimates that the trade war is going to wipe out the equivalent of $585 billion worth of economic activity that would have occurred without the trade war. So there's certainly going to be a tightening. And the real measure that we should be watching is whether or not business investment is going to be dropping in this next quarter, which is very likely given the the nonsense going on with Brexit, the China trade deal, and also these kind of worrying signs that we're seeing with the yield curve inversion. But just one thing, with business investment, we've talked about this before. So much of this investment has been focused on IP, intellectual property investment, which is predominantly just trying to gain as many rents as you can out of the economy. So the question is, has this business investment even been sort of pushed toward a direction of the economy that's not going to be able to manifest outside of a time?
David, really quick, explain what you mean by rents. That's important.
Yeah, so basically you're having IP and you create a new technology or even a new technique, and you prevent opponents from, competitors from being able to use that technology, or that you're able to sell it off to lots of different,
and
organizations.
This could be in tech, which strangles innovation and creates rent squatter space for something like Microsoft Word, but it could also be in pharmaceuticals or public health.
Certainly pharmaceuticals, and also the torture box that Amazon patented a little while ago. I don't know if you guys saw it, but it was like a timeout box for workers. Anyway, Amazon was like, we patent everything. So, that's something that's definitely worrying, because this is not necessarily something, not that all IP investment is necessarily bad. It just has been the driving focus of a lot of corporations to be able to gobble up as much intellectual property as possible. That's the worrying factor. Now, now that we're starting to see this worrying moment, though, we really have to remember that this recovery has really been a recoveryless recovery for working people. It's been a recovery that's been fueled on debt. Credit card debt has only continued to increase since the financial crisis. Student loan debt has exploded. Private household debt has exploded. And, just recently there's been a lot of worrying signs of people missing car payments, which is also a very dangerous indicator that things aren't going very well for most working people. And this is supposed to be, a time of relative prosperity with the low unemployment numbers. And we're seeing more and more that that's not necessarily translating into a better situation for working people, because the fundamentals of our economy are absolutely broken. And now we're in a moment where the Federal Reserve has basically been trying to float the economy for a very long time on basically sugar rushes. And they're so low. Trump has been sort of bullying around the Federal Reserve to continue to keep interest rates low. And I'm not necessarily going to jump into that discussion about whether or not they should do that. But the reality is that there's a severe limit in fiscal policy that the Federal Reserve can continue to pursue. And the strategy following the financial crisis has been very limited in its ability to actually create a vibrant economy for most working people. And just worrying enough, today marked the FDIC and the Office of the Comptroller of the Currency approved changes to the Volcker Rule. And the Volcker Rule was put in after the financial crisis that was supposed to stop prop trading, which was a major factor in the financial crisis initially, which is basically the banks were leveraging their capital to create, small bets, and if those did not hit, were very much exposed. And what happened is in in the financial crisis, there was such a squeeze that all of this risk that these public banks, that these private banks had been taking on, basically exploded, and there was a huge, everyone was trying to get their money out, and basically banks stopped lending to each other. It was a massive disaster, and of course, the $16 billion lost by the 6 biggest lenders were immediately bailed out by the United States government. But the worry is basically this kind of very dangerous practice that the Obama administration stopped. And by the way, the Obama administration stopped in such a half-assed way. Goldman Sachs was in the room when they crafted this rule, and they were very influential in actually making it as complicated as it was. So this is a big thing. They say, oh, it's really complicated, we don't know what it is. Well, they were in the room actually fighting to make it more complicated because they wanted to use that as an opportunity to pull it away. So now, of course, under a Trump administration, they're trying to push so much deregulation that we really are entering into a moment where the kind of reckless activity that created the crisis is being reintroduced to a situation of massive stagnation in working class wages, and also a real serious moment of a lack of ability for the Federal Reserve if they use their traditional playbook. There's things that a central bank can do, but the way that the Federal Reserve has operated in the entire modern history of the United States, right, does not have a lot of tools to use. So when we're talking about this potential of a recession, we really are in a dangerous situation without a kind of real radical movement to start talking about debt, to start talking about workers' movements, and we cannot rely on fiscal stimulus from the Federal Reserve anymore, and we need to have a much bolder approach to dealing with the fundamental contradictions of capitalism that continue to lead us into constant modes of crisis, constantly.
As Richard Wolff says, if capitalism was your roommate, you'd want to move out.
That's actually a phenomenal line.
I mean, it's a great analogy. It's just like, yes, we just have a system where every several years, pretty much inevitably, the entire world goes into catastrophe. You've just watched a Michael Brooks show video, and you can watch all of our full main live shows every Tuesday night at around 7 p.m. Eastern Time, and subscribe to get all of the clips you want. We're covering the globe. We're focusing on international relations, the intellectual dark web. We're having fun. We're doing deep dives with a lot of amazing guests. Of course, become a patron for the whole thing at patreon.com/TMBS, or subscribe to this YouTube channel and help us keep growing and get that content out there. Subscribe below.